Hi, I'm Carlos Lopez, Managing Director of Creative Planning. Welcome to our video to explore the 6 investing biases that can wreak havoc on your portfolio. In this 5-minute video, we'll delve into each bias, provide specific examples from Peter Mallouk's book, The 5 Mistakes Investors Make and How to Avoid Them, and we'll offer practical tips on how to sidestep them. Ready to learn more? Let's get started. Our first bias is the confirmation bias. This bias occurs when we actively seek out information that supports our existing beliefs and we ignore all the evidence to the contrary. It can lead to tunnel vision and prevents us from making well-rounded investment decisions. Now, Mallouk shares an example in his book where an investor who believes in the potential of a particular industry only focuses on positive news from internet searches and ignores warning signs or critical analysis. To avoid confirmation bias, challenge your assumptions and actively seek diverse perspectives. Take a devil's advocate approach. Ask yourself what could go wrong and then look for those answers. Engage in constructive discussions with individuals who hold different viewpoints and explore alternative strategies. Our second bias is overconfidence bias. Now, this bias arises when we overestimate our abilities as investors. This can lead to excessive risk-taking and potentially disastrous consequences. Mallouk's book provides an example of an investor who experiences a series of handful of successful trades and then becomes overconfident, takes on excessive risks, and does this without considering potential downsides. To combat this, you want to regularly assess your investment skills and acknowledge your limitations. Seek the guidance of a financial advisor who can provide a realistic perspective on risk management, portfolio diversification, and potential blind spots that you might have overlooked. Our third bias, herd mentality. Now, this bias occurs when we blindly follow the actions of others without conducting our own analysis. Mallouk shares an example in his book where investors pile into a particular investment or asset class, or maybe just the investment because everyone else is doing it, such as meme investing. This is done usually without considering the underlying fundamentals or the risks involved. To break away from the herd, conduct your own independent research and make investment choices based on your own financial goals and risk tolerance. Avoid making decisions that are solely based on the popularity or the actions of others. All right, let's move to bias number 4, loss aversion. This bias causes us to fear losses more than we value gains, often resulting in irrational investment decisions that are driven by emotional responses. So Mallouk shares an example here of an investor who becomes emotionally attached to a stock, holding it despite clear signs of deteriorating fundamentals. The impulse here usually is just to hold the stock until it comes back, but this is often the wrong decision. So to counter this, you want to adopt a long-term perspective and really focus on your overall investment strategy rather than short-term market fluctuations or performance. So regularly assess your investments objectively, considering the potential risks and, of course, the rewards. Okay, let's talk next about anchoring bias. Now, this bias occurs when we rely too heavily on information or a reference point, anchoring our decisions around it. So Mallouk discusses an example where investors hold on to a stock they purchased at a high price, hoping it's going to reach that high price again despite new information that suggests otherwise. To avoid anchoring bias, continuously reassess your investments and avoid fixating on past performance or your initial purchase prices. Rather, make your decisions based on current market conditions, the merit of each opportunity, and the evolving landscape. Finally, let's talk about recency bias. This bias causes us to give more weight to recent events or trends that overshadow long-term data. So Mallouk shares an example of investors who chase the latest hot investment trend without considering its long-term viability or the potential for market cycles. So to counteract this recency bias, maintain a disciplined investment strategy, review historical performance over extended periods, and avoid making impulsive decisions based solely on recent market movements. Remember, past performance is not always indicative of future results. By recognizing and addressing these 6 investment biases, you can make more informed decisions. Remember, investing is a journey. It requires discipline, research, and a long-term perspective. Consult with a financial advisor who can help provide valuable insights that are tailored specifically to your needs. Thank you for joining today. We hope this video has shed some light on some top investing biases that can wreck your portfolio and provided you with some actionable strategies to overcome them. And hopefully you can discuss this with your current financial advisor. If you don't have a financial advisor, reach out to us here at Creative Planning. We look forward to getting to know you. See you in the next video.